Institutional investors. The people who chase alpha harder than crypto bros chase airdrops. These are the big dogs of finance, the pension funds, the insurance companies, and those mysterious endowments that somehow own half the planet's real estate. And lately, all of them have been obsessed with one thing. Not stocks, not crypto, not real estate, and no, not AI either. It's an industry so boring sounding, it makes accounting conventions look like Coachella. It's private credit. Yeah, I know what you're thinking. Private what now? But stick around because this boring asset class quietly turned into a $2.5 trillion machine that's printing billionaires faster than you can say liquidity crunch. That's trillion with a T. For context, that's bigger than Australia's GDP. But let's be honest, that's not exactly the flex they think it is. And here's the crazy part. Private credit has delivered nearly the same returns as the stock market over the past 2 decades, just without the emotional breakdowns that come with watching your portfolio crash every time Jerome Powell clears his throat. So, if this thing is such a powerhouse, why does nobody outside of Wall Street know it exists? That question sent me down a 2-month rabbit hole into one of the most quietly powerful industries on Earth. So how did this snooze fest become Wall Street's new addiction? Let's find out. Alright, let's keep it simple. Imagine you're a company that needs a loan. 30 years ago, you'd walk into a bank, shake hands with a guy named Chadwick, and boom, money wired. No stress, no credit checks, no awkward PowerPoint presentations. Chadwick didn't care that your last company was a failed liquor store or that your business plan was written in Arial. But that was the old world, the pre-2008 world. Back then, banks were throwing money around like they'd just invented it, and surprise, surprise, that didn't end well. After the financial system nearly yeeted itself into oblivion, everything changed. Banks suddenly got stricter than your parents after you crashed the family car. Now, when you apply for a business loan, you fill out 80 pages of forms, pledge your firstborn as collateral, and wait 6 months for a polite rejection letter. And that's where private credit enters the chat. Private credit is like the sketchy but cool uncle at Thanksgiving who says, "Forget the bank. I'll spot you the cash right now," but you might not love the interest rate. Instead of going to a traditional bank, companies borrow directly from non-bank lenders. Think names like Blackstone, Apollo, and Ares. These firms hand out multi-million-dollar loans the same way your friend Venmos you $20 for pizza. Except this time it's $200 million to keep a struggling oil refinery alive. So why is private credit suddenly the star of the show? Because finance, like your ex, follows one golden rule. If there's a hole, someone's gonna fill it. Let's rewind for a second. In the early 2000s, private credit was a niche market, about $140 billion globally. It was basically private equity's weird little sibling. Then came 2008, the year banks discovered what happens when you hand out mortgages to people with no income, no job, and no assets. Yup. The infamous ninja loans. Banks bundled all those bad loans together into ticking time bombs called CDOs, collateralized debt obligations, and when they inevitably exploded, the global economy caught the shrapnel. So regulators stepped in and said, "Alright kids, no more chaos, time to act like adults." They forced banks to tighten lending rules, hold more capital, and cut risk. And suddenly, all those medium-sized companies that weren't big enough to issue bonds on Wall Street but too large for your local credit union, they were stranded. They still needed money, but no bank wanted to touch them. Enter private credit. The cool, confident alternative lender who says, "The bank's ghosted you? Don't worry, I got you. Just sign here, pay 10% interest, and we'll toss in a couple of fees for fun." And boom, companies lined up faster than people outside a Lululemon drop. By 2010, private credit had grown to about $300 billion. By 2020, it had passed $1 trillion. And today, over $2.5 trillion. That's not growth, that's a financial glow-up. Over the past 20 years, private credit has returned roughly 9.6% per year. The S&P 500 did about 10.2%. So, sure, the stock market technically wins by a hair. But here's the thing. Private credit doesn't give you the constant anxiety of daily price swings. No red day panic, no Reddit threads crying about Jerome Powell. Private credit is boring, steady, consistent. It's the financial equivalent of a golden retriever. And that's why institutional investors, pension funds, endowments, and insurance companies are drooling over it. For years, bonds were paying next to nothing, stocks were volatile, hedge funds were charging insane fees. But private credit? It's the Goldilocks asset. Too risky for banks, too safe for hedge funds, and just right for anyone managing other people's money. It gives giant funds a place to park their trillions with solid returns and minimal drama. Sounds perfect, right? Well, not exactly. Because behind the curtain, there are cracks forming. Private credit might look smooth, but it hides some major risks, like liquidity, you can't easily sell it, valuation, nobody knows what it's really worth, and defaults, companies not paying back. There's no public exchange, no daily price updates. It's all private deals and spreadsheets. Basically, it's like buying a mystery box that only gets opened when something goes wrong. But here's the wild part. Investors don't seem to care. They're like, 9% returns, who cares what's inside? And that's the real magic of Wall Street. As long as the money keeps flowing, nobody asks too many questions. Because the entire private credit boom is built on one fragile assumption: borrowers will keep paying. And to be fair, for the last decade, they have. So maybe private credit really is the next big thing. Or maybe it's just another financial bubble wearing a new designer suit. Nobody truly knows. But what we do know is this: Wall Street's getting richer, the funds are getting fatter, and your 401k probably owns a slice of this beast without you even realizing it. So, what do you think? Is private credit the future of finance? Or is it just Wall Street's latest way of playing hot potato with debt until something breaks again? Let me know in the comments. Because if history has taught us anything, it's that the music always stops eventually. And when it does, someone's left holding the bag. Until then, the story keeps going, the money keeps flowing, and Wall Street keeps pretending the music will never stop. But hey, who are we to ruin the party? If you enjoyed the video, hit that like button, subscribe, and drop a comment before the algorithm forgets we exist. And if you haven't seen the last video, go check it out. It's basically the prequel to this financial soap opera. Thanks for watching, keep your wallet safe, and remember, if it sounds boring, it's probably making someone very, very rich.